Hello again, everyone. I'm David at GoRobinhood.com. Welcome to the video ETFs versus mutual funds. This is one of our favorite topics since we are big proponents of passively managed funds and especially ETFs. I'm going to do a very quick review about some of the advantages of using funds for your investments. As a basket of securities, this allows you to invest in the markets as a whole or sections of the markets much less expensively than if you had to go out and purchase shares of each of the individual securities. Funds can be used to cover broad indexes such as the S&P 500 or very specific areas of the markets. They eliminate company risk. They also aid in diversification. Most experts agree that your broad asset allocation is going to have far more of an impact on your long-term success than would individual stock selection, and in general, funds have less volatility. We've all seen how this works, we all know how this works, but just in quick review, the individual purchases a share of the fund owns shares of all of these companies, and this allows the individual access, the ability to invest in an entire area of the market through one share. So individual stock selection has created a lot of wealth in this country. It has also taken a lot away. If you don't have a lot of capital to diversify completely, do you catch Lululemon at the right time or the wrong time? Perhaps Lowe's Home Improvement at the beginning of a home improvement store trend? Or do you catch an Enron or a Krispy Kreme at the wrong time? Investing through the whole area of the market or the markets as a whole through a fund can help equalize some of that risk, some of the company risk, and some of the swings that individual stocks can produce. There is a massive migration underway. This is a look at ETF assets in the last 10 years. Investors are selling their actively managed mutual funds. They're very expensive. These funds are being replaced with passively managed funds. This is ETFs in the last 10 years, and this is $1.3 trillion as of 2012. To put that in perspective, this is a look at the amount of dollars invested in both mutual funds and ETFs. We're looking at the last 10 years. You'll notice that the amount of money invested in mutual funds has not quite doubled. In fact, it's up about 76%. However, if you look at the trend, ETFs in the last 10 years, the amount of dollars invested has increased by 785%. So this is a very compelling trend. So why is the trend occurring? Well, ETFs essentially serve the same purpose within your portfolio. However, they're far less expensive. They're more tax efficient, more flexible. They're now available without any transaction fees. They provide a much truer representation of the index or sector that you're trying to invest in. And you don't have to worry about your fund manager and where he ranks amongst the thousands of funds that are out there. Let's quickly touch on index funds. So index funds are actually mutual funds, and they have been around for a long, long time. They are also regaining in popularity. They are bought and sold in the same manner as a traditional mutual fund. Their DNA is much closer to an ETF, however. They're both passively managed. This allows them to have very, very low fund expense ratios. So why are ETFs, and index funds for that matter, so much less expensive than mutual funds? Primarily because of how they're managed. So mutual funds are actively managed. They have a fund manager pulling the strings. The fund manager is paid a very, very expensive salary. They automatically start out behind the benchmark because they have to cover their salary. And it's been proven time and time again that the mutual fund managers cannot consistently beat their benchmarks. So this would be a great topic to Google. I think you'll be amazed. ETFs and index funds as well are passively managed. And basically that's it. There's no salary to pay. You're going to get a truer representation of your target, your investment target, and you're going to get pars every time. You're not going to beat the index by 2 one year and trail by 3 the next. You're going to get a very true representation each and every time. Here is a look at the equity mutual fund fees for the last, 14 years? As you can see, this is the average of what all equity funds charge, 1.4%. However, this is what investors are willing to pay, 0.77. So keep in mind that index funds are skewing this number a little bit. But as you can see, ETFs are not only having a positive effect on investors directly, but they're also helping to drive down the fees for mutual funds. This is a snapshot of the equity ETFs at Vanguard. It really doesn't matter if you pull up ETFs at Vanguard or Schwab or State Street or BlackRock. It'll be the same story over and over. ETFs are going to be substantially less expensive. And once again, you do not have a fund manager to even worry about. So there's really not a reason to judge quality other than the fact of the expense ratio. 12B1 fees. You know what? I'm just going to say that these were set up with good intentions. They're actually trailing revenue that goes from the mutual fund company back to your advisor. This is a reward for choosing their fund and placing you, their client, into that fund. This is a major conflict of interest. I'm going to also recommend you Google this one when you have time. Tax efficiency. Mutual funds are not very tax efficient. The reason for this is with a human fund manager, you're going to have investment turnover. You have very little control. There are taxable distributions in mutual funds. Even in years when your fund goes down, you can be assessed with taxable distributions. So this can also be a conflict of interest. If the fund manager falls behind of his index or the other funds, they're trying to catch up. It's possible they make more moves to keep their job. By doing that, they can certainly create more taxable events. ETFs, on the other hand, very tax efficient. They follow the index or the sector, less turnover. You're actually in control of when you want to take your gains or harvest your losses from the fund. So you're not at the mercy of the fund manager. Much better and easier way to manage your taxes. ETFs are also more flexible. They can be bought throughout the day. Mutual funds are priced once a day. You can have customized buy and sell orders. You can use options. They're also far more transparent. Concerns, transaction costs, not anymore. The online brokers are providing high quality ETFs and other funds as well with zero transaction fees. They're not going to let you trade these, but they're perfect for investors. As long as you hold the fund for 30 days, there's no early redemption fee. You just have to be careful. The reason they're doing this and providing you with these free funds, if they can get your business, then you realize you can't rebalance. They can funnel you into their managed money portfolio models, which are almost as expensive as the full service brokers. So take advantage of these high quality funds and zero transaction costs and rebalance right here with us at GoRobinhood.com. Problem solved. Tax liability when switching. This is only an issue in taxable accounts, not an issue in your IRAs. We did make a video. We are not tax professionals, but we certainly shed some light on the calculations and things that you would consider when making the switch in taxable accounts. And hopefully this will give you a little bit of insight and help you make a better decision. Liquidity and spread are really no longer issues. There's such high volume in most of the popular ETFs now that this is no longer an issue. Okay, the bottom line, we believe that it'd be very well worth your time to investigate a little further and consider switching for the long term. Please use independent sources, and remember, it doesn't cost anything to investigate. We think it's a very compelling story. It could be very, very beneficial for the majority of investors. Thanks, everyone. Have a great day.